Welcome to probably one of the most important parts of this program is how to invest safely and how do we create a retirement plan that will allow us to have passive income for life that actually replaces our own income. And that is very possible with the techniques we're going to talk about in this program. Will Rogers said once, the problem in America isn't so much what people don't know. The problem is what people think they know just isn't so. And this is so true with the financial system that we have. Many people use advisors, brokers, 401k plans, and have no idea about investing and think it's very difficult. But in this program, we're going to talk about a safe, simple way, and I'll let you download my book on this system and give you advice about which way is the best stocks to look at and understand this type of dividend investing. We first must understand advisors, brokers, mutual fund managers, because most people will invest with them because they have no idea about the market and how it works. We have to understand that these are actually well-meaning people, but they are salespeople, and they want to sell a product because they would like to get at least 1% of the money that you make back, and mutual funds will probably get 2 or 3% of the money you make, which doesn't seem much, but in reality is very much. They will charge you 1 to 3% of your entire portfolio, even if you lose money that year. This will allow them to take 50 to 70% of all your gains. So basically, you're not making that much when you're giving them 1 to 3% of their return. Some brokers will continually buy and sell stocks. That way they make more money in their transaction fees and also the taxes that are going to be charged you. Most financial experts make the simple complex. They will confuse you with terms such as modern portfolio design or asset allocations, so you don't really learn how to invest on your own, but it is fairly simple. You'll do better than 96% of all the mutual fund managers by investing on your own into a S&P 500 or US total stock market index fund. So example, if you were able to invest $4,000 a month for 30 years at 7% return, you would have $3,781,475. But let's say you give the advisor 1% of that. Well, that advisor over that time will take $962,000 of your earnings at 1%. That's 25% of the total return. If it's 2% or even, let's say, 3% with 2% mutual fund fee, they will take $2,334,230, which is 62%, and some brokers and different mutual funds will take up to 4%, which they will take 3/4 of the money you make with a 7% return on your money. And isn't that crazy? You think it's only 1, 2, or 3, or 4%, but in reality, you need to learn on your own. And so basically, you go to this website that you're on now and look under resources, and you want to check out how well your advisor has done. And so you'll go to the S&P 500 area here and click that. This is a comparison against how well you have done in your retirement plan or investment with your advisor. And who knows, maybe the advisor does better than the S&P 500, but it'll be worth finding out exactly, how well they have done. And so you can ask your 401k plan administrator, just ask them for the past annual reports for the past 15 years, which they have. Or you can get copies of the 5500s that they submit. And this will show you the beginning balance and the amount of contributions. And then you just plug it in. It's that simple. This is an example of the 5,500 that also tells you how much you put in and initially started with and how much you put in each year. It's in the homework. Here's one of my friends that he went in and he had an advisor put about $15,000 a year in his SEP IRA. At the end, he had a little over $300,000 earnings, a total value of what he had in. When compared against the S&P 500, if he would have just put it in the S&P 500 instead of $320,000, he would have had $636,000 in the final result. And that's really a 50% loss of the income, which is about appropriate when you take in fees. Here's another example coming up here. This doctor had a lot more, had defined benefit plans, had all the different ways you could save money, and he put maximize this tax to save taxes. In reality, he ended up with about a little over $2 million, but if he would have just put it in the S&P 500, he would have had over $4 million, half again. So it's worth it for you to evaluate how well your advisor has done. And if they haven't done as well, or if they've done well for the S&P 500 and you're making more money if you would put it with them instead of the S&P 500, I'd probably stay with them. But if they haven't, then you should pay attention and learn a simple technique on how you can invest, basically using about an hour a month looking at your portfolio. You buy companies you keep forever. Should you use a financial advisor? I think in some cases, if you really don't understand any of this, then I would look around. I would compare your advisory fees to the S&P 500. If not, I would look for someone that actually knows how to invest in dividends. I would learn at least how to invest in dividends. My 12-year-old grandson is investing in dividends, and he understands it. It's not that hard. Good advisors will prevent you from doing stupid things. The market is dropping now. Who knows, with this recession can go in half. And basically, they will tell you not to sell and hold on, even when it goes down. The great thing about dividend investing is you hope it goes down because you're able to buy more stocks at a lower price, because you don't care what happens to the market, because your constant source of income through dividends keeps going up every year if you're with good companies. And I would only use a fee for service. Basically, you pay them by the hour, not a percentage, because you saw what happened when you paid them a percentage of your portfolio. You have an advisor that understands investing in high quality dividend stocks, because this is the fastest way to become wealthy. Now, just investment disclaimer, the following investment information I have found to be useful. I am not engaged in rendering professional services. If you require professional assistance or advice, seek a competent professional. I specifically disclaim any responsibility for any loss, liability, or risk, personal or otherwise, which is incurred as a consequence, directly or indirectly, by the use of application of this contents or this presentation. So, steps to accelerate financial freedom. First of all, learn how to make more money in your business or at work or whatever. We talked about that. Use the extra money to get out of debt quickly. Remember, that's the best and fastest way to become wealthy is paying off debt. Now, during that time, I would learn some of these techniques in a small amount. If you have some money in a Schwab account or whatever, then I would practice with this in small amounts to get a feel for how to use dividend investing. You want to evaluate the success of your financial advisor or the strategy that you're using. Focus on using Roth IRA strategies, because we definitely don't need to give the government any more than they need. Each one of you could be debt-free, like we talked about, in 5 to 10 years, and financially free in 15 years, and especially if you understand this system of investing. I've also wrote a book. It was called The New Wealth Paradigm. talks about debt reduction. I've also written another book on dividend investing. By the way, both of these can be downloaded free at DrAce.com. So the three main enemies of creating wealth are taxes, which may possibly go up, inflation, which has risen to 40-year highs at over 8.5%, and of course the last thing is the financial service industry. There's a book by William Bernstein for young individuals. He talks about how to get out of debt, things like that. He says you have to act as every broker, insurance salesman, mutual fund salesperson, and financial advisor you encounter is a hardened criminal, and stick with low-cost index fund or actually dividend investing, and you'll just do fine. So we have to change our financial encoding. This is a paradigm shift. Almost everything we've been taught about money and investing just keeps us poor. We've talked about those things like, the 300% home payment that you're paying toward interest will make other people rich and us poor. So as we have here, you must unlearn what you have learned. So remember, we've already talked about what is the real interest rate on your house. It's somewhere between 200 and 300%, which is an opportunity because you, by paying it off early, can make 200 or 300% return on your money, guaranteed without risk and no tax consequence. The idea of retirement plan, there was this book, it was called The Big Retirement Lie. And in the back of the book, basically, if you were 30 years old and you invested for 35 years, and let's say you had a regular IRA, not a Roth, my recommendation is always a Roth. But if you had an IRA, you could write off $1,800 in taxes a year. Great. And so basically, over the next 35 years, you were able to write off $63,000. But because you're in an IRA, over the next 30 years, when you retire, you will pay back over $760,000 in taxes because you borrowed $63,000. That's why it's important to have Roth IRAs. And the problem with tax-deferred investing is taxes are not eliminated. You're going to have to pay them. And in that case, you traded $63,000 for $790,000 in taxes. And actually, the tax rate may be higher. It was at one time 70%. We don't know. You can lose 50 to 70% of your returns in these plans with your advisor. Remember, 2 to 3%, we showed you that, especially if you're in mutual funds. And I highly recommend not mutual funds, but individual high-paying dividend stocks. Your money is locked up with the government until you're 59 and a half. And if you take it out, there'll be an extra penalty associated with that. Plus, you will pay the taxes. And when you reach age 72, you're going to have to take out a certain amount each year or each month out of your plan, or you will be paying a large penalty. That's another problem with tax-deferred investment. The market has only averaged around 3.88% over the last 20 years in these plans. You cannot write off any losses in these plans. The government can change the rules like they did with the Roth. As an owner, you must pay all the additional fees, expenses of the plan, plus pay for your employees. Here's an example of 401 compared to just a regular Schwab investment account. If you pay an extra 3% advisory fee when you are making 7%, your real return is 4%. And so, yes, you basically don't have to pay the taxes, so you can pay $8,333 a month. Or on the other case where you just have an account, but you'd be getting 4% because they're taking 3%. But if you do this on your own, you're going to get 7%. Yes, you have to pay tax, and now you have to put in $5,800 is all you can invest. But over time, over 30 years, I think this is, basically you will be getting this average is basically in the taxable tax-free account. Basically, you're going to be having a total of, well, let's say you have ended up with $6,000, $6 million, and you're going to get nine-tenths of that. So now you have $5 million, but then you have to pay, let's say 30% tax, and so really you end up with 3.8 million versus someone that just didn't do the taxable account and you had $7,928,000 and you pay capital gains on your long-term capital gains, or basically a qualified dividend, you're only going to pay 20% in tax. So now you end up with $6 million. The bottom line is, with your 401k, you're going to your return is $3,825,000 compared to $6,342,000. And so the point is, now let's say you don't put as much in, but basically you've got 10% of this, you'll have like $385,000 compared to $634,000. That's 10% less. So the point is, we need to understand that having money in a tax deferred environment, unless it's a Roth, is probably still a loser's game. So let's look at return on investment. Under the mattress, you get 0% return. Banking is checking account, 0% return. You might get, it's probably gone up to maybe 0.05%, tax, which is taxable. A Schwab money market might be about the same. Short-term treasuries is right now 0.04%, which is taxable. The stock market average has been about 4.25%. S&P has been a 7.45% over the last 20 years. But dividend investing, which we're going to talk about, is usually 2 to 3% greater than the S&P 500 if you select the right stocks that have increased dividends consistently for at least 10 years, maybe longer, maybe even 50 years. And paying off debt is a guaranteed return of 100+%. So that's where we focus our money. We have to remember that one of the big things that takes our money is inflation. And like I said, it's right now in 2022 is around 8.5%. So we need to do something that beats inflation. Dividend growth investing is one of the best proven ways to build wealth. This is Ronald Read. He spent the first half of his life as a gas station attendant, and then the rest of his life as a janitor at his local JCPenney department store. But when he died at age 92, he left behind $8 million in fortune, basically all in dividend-paying stocks. He understood the value of individual investing. He learned how to do this when he was younger. And you can too. All you need is a way of learning how to do that, and this is what we plan to do in this program. You want to actually invest like Warren Buffett. Warren Buffett has a lot of dividend-paying stocks with great companies that he keeps forever. He said you need to learn to invest on your own. Invest in what you understand, identify and buy undervalued dividend stocks, undervalued. Find businesses that you have stood the test of time, like Lowe's, McDonald's, Coca-Cola, Target. A lot of these great companies have stood the test of time, some for over 100 years, some for 150 years, and learn how to invest in those great companies. Be aggressive when the market tanks or drops. Remember, as a dividend investor, you hope the market drops because you're never planning on selling any stocks. You are just keep getting an increased flow of cash every year. Keep great companies forever. So right now, most of you are just chess pieces on the chessboard, okay? You need to learn to be the chess master. It doesn't take much to learn this. If my 12-year-old grandson can figure it out, I'm sure that you can. A lot of people fear the market. Here's an example when the market is down half, and this is around in June, is the worst first half since 1970. Market tanked. This was a great time to buy great companies undervalued. And the market will go up and will go down. We don't know if there's going to be a recession. The president says there's no recession, although everything says there is a recession. But also, maybe over the next year, things may even go down further. Great time to buy undervalued companies. So, for example, in June of this year, 2022, the market hit a low, and it was down a matter of 23.9%, the S&P 500. Now, the SCHD, which is 100 dividend stocks that Schwab also, you can buy as an ETF, was only down 14% versus 23%, which means it's very safe, it's resistant to drops, but it also goes up very high, and you get a higher dividend return on your money, like almost 3.4% compared to the S&P, which is like 1.5%. But my portfolio of the companies that I have in my list, the ones that I purchased myself, have been actually up 2% during the same time frame. So that's the power that dividends have to resist drops in the market. So the best book out there I would highly recommend you read besides mine, which is a very short book of 50 pages, and you can download that book, is The Dividend Growth Machine by Nathan Winkelfleck, a young man, and he said to have a perfect investment, which are dividends, it should grow your wealth reliably over a period of at least 15 years or more, because you're going to have this forever. Have great companies that have continually paid dividends for over 50 or 60 years. It should minimize volatility, which I showed you in the last slide. It should generate reliable passive incomes, enough to pay your own bills, and you will be able to do that with this type of investing. That income should grow at least as fast as our expenses and beat inflation, which it does. It should be easy to understand and follow. Now, looking at the S&P 500 from 1960 to 2021, if you basically spent all the dividends, your $10,000 would have grown to $795,000. But if you reinvested the dividends, it would have been over 6 times more than if you would have just used the dividends. That's the power of dividend reinvestment. And those that are working can do that. But there are a lot of people that I know that actually, use their dividends. And I'm going to give you an example of someone that. So when you go to DrAce, you can download, go to, resources. In there, you'll be able to download my big little book, which has just been updated as 6 September 2022 in this program, and learn step by step how to go through this process. It even has a list of different dividend companies that have stood the test of time, they're all aristocrats. They all, none of them were cut during the last recession or cut dividends. They're very strong companies. But you're going to do this on your own. You have to educate yourself. So you'll need to read this book. I'm going to recommend a few other books, and then do it slowly, start slowly to understand this process. Because Warren Buffett says, if you don't find a way to make money while you sleep, you will work until you die. And dividend growth investing will give you that income. So what really are dividend stocks anyway? Well, a dividend growth stock is a company that basically has a proven track record and raises dividends each year, a cash payout to the shareholder. For example, if they make $100,000 and they decide to give half of that, $50,000 in cash to the shareholders, and that is called a dividend. High quality dividend growth companies typically dominate their industry because they're very strong companies. They have plenty of money to give out. They make great profits. They generate massive amounts of free cash flow. As a result, they're able to pay their shareholders a portion of that cash from dividends and that have increased every year, often rising faster than actually the rate of inflation increases. I mean, like for example, Lowe's increased their dividend this year by 31%. It's amazing. The beauty of owning a stock like this is that no matter what happens to its share price, the share price doesn't matter, as long as the company continues to grow dividends, as a shareholder stands to collect larger and larger payouts every year. They just keep going up and up and up. You might start getting 4% a year in the dividend, and as they increase over maybe the next 5 or 6 years, you're getting actually maybe 8% return on your original investment. That's why these stocks are so compelling. You buy them when they're trading at a reasonable price, hopefully undervalued. You hold them forever, and then you get showered with growing cash payouts and potential for decades. Basically, it's like a little cash machine. Every month, a bunch of money just spits out into your bank account. And personally, if you're working, I would reinvest that money because the returns are so much greater. This is Nathan Winkelpleck. He's the one that wrote the book we talked about, Dividend Growth Machine, and he has a video called The Power of Dividend Growth Investing. Go to YouTube, download it, and you'll learn about it. But this is part of his video that I took off. So this is Texas Instruments. He's looking at one company. And so, for example, the person had $1 million in around 2008, just before the market crashed, and bought 29,000 shares of Texas Instrument. And basically, they were, but then the market dropped in half. And the price of the stock dropped from $1 million to $464,000. Now you feel kind of bad about that, but you don't care because you're a dividend investor. And basically that year you made almost $12,000 in dividends. The next year the dividends increased by 10%. So then you made $13,000. Over the next 13 years, instead of getting $12,000, and this is spending all the money, all the dividends that you got, it continued to grow. The dividend grow. Now you're getting $122,000 in dividends, doing nothing, and spending all the money you got. If it follows the same path, at the end of another 10 years, you'll be making over $300,000 in dividends coming in, just passive income, not doing anything. You bought it once, you hold it and held it. And by the way, this money that dropped to $464,000 in basically 2 years, or 13 years, has grown to $5.6 million. This 400,000 grew doing nothing just because the price went up. And then actually over the next 10 years, it will grow to over $9 million. Now, for example, if you reinvested the dividends, instead of getting $122,000, you're getting $230,000 in dividends, and your portfolio didn't grow to $5.6 million, it grew to over $8 million in 13 years. This is the power of dividend growth. This is why we want to learn what companies to buy, what companies have grown dividends consistently for over 25 years, and this book will share that with you. So basically, dividends are part of the company's profits. And basically, like Texas Instrument, basically they're paying 2.51%. Their average 3-year growth is like 17% a year. And basically the dividend is $4.60. They've increased dividends for 19 years. Now, some of the companies we talk about have increased dividends for almost 60 years. And we'll talk about those later. So basically, what your return is the price of the dividend return divided by the price. And so this is why you're getting 2.51%. That's how you figure out the dividend. So each month I get a certain amount of dividends. I have IBM, and basically was paying, $1.64 in dividends. So this quarter. So basically, when it pays the dividends, I have 1,000 shares. That means the little bank machine is going to pump out $1,640 this quarter for me that I get from them. It's like cha-ching, and I did nothing. Money just pops into your bank account. So these books I would recommend you reading. First, Dividend Growth. It's only, if you listen to the audio, it's a little over an hour. Same with Dividend Machine Very. This one is an older book. It's a little bit more in depth. It's not published anymore, but you can get it on Amazon used. So buy stocks when they're in value, buy right, hold tight. And so the idea of buying stocks when they're undervalued, and there are many places to evaluate that. In my list of stocks, I show you how to evaluate if a company's undervalued, and whatever, a step-by-step approach to determine that is better than when they're undervalued, because then you can buy them at a great price and with the potential of going up. So you first look at my list, and the way I would look at that, you want to look at the 52-week range. And I would like the range somewhere below 50%, but more likely below 30% on the low. Personally, I would hope I could buy a company when it's at its 52-week low, if it meets all the other requirements of a great dividend company. And my list shows you where that is. Also, Morningstar has a rating. You can go there. They have a rating, like a 4 rating would be undervalued, a 5 rating would be actually significantly undervalued. So I would focus on the 4 to 5 rating. Basically, Safe Simply Dividends also does a rating on the stock and tells you when they're undervalued. These are all places, probably the best newsletter out there to understand when a company is truly undervalued, and gives you actually the price you should pay or less than that, is the IQT newsletter, and I'll talk about that. Jason Fiber has YouTube videos, and he talks about different companies that are undervalued. I'm just going to just briefly go through that with you. This is my list. It's hard to read here, the most current list, but you can look at the list, and let's say Tyson Food, this is at a 0, so basically it's at its 52-week low. It tells you the price, it tells you the dividend yield, which is 2.47%, and the amount of dividend paid. It's been paying dividends for 11 years. It has a rating in the S&P 500 and 99. This is the highest it goes as far as safety rating, so that it has a low moat. We'll talk about that in my book. But it's rated 4, which is undervalued, and also the basically Safe Dividends rates them. So this is a list, and I basically line up the list by this day, which is today, by the lowest, most when they're at the low 52-week low. So we know these are great companies, and then we would look through it. The ones that are marked in bold would be ones that would be worth looking at to buy. But you have to make your own decisions. This is just for informational purposes, and but it gives you an idea as I've gone through and looked at great companies. So here's the Morningstar analysis of, let's say, BFC. It's at its 5-star, which means it's severely underrated and undervalued right now compared to what they think the value is. Now, this is all subjective and whatever. This is just a guideline. You have to make up your own mind of what you feel, if that's as true or not. Guideline. Here is the Safe Simply Dividends, and You can see down here it's at its 52-week low compared to up here. The P&E's in a safe range, 13%. And you can see when the dividend yield is much higher than the average and the P is below average, they considered this undervalued. And this is the IQT newsletter. It's a service that you can get once a month or twice a month. It's a great newsletter. My friend of mine uses this. I use this to determine when a company, and here they will even tell you that the 3M is undervalued at $199, yet it's selling for $152. It's even lower than that today. Might be a good value to look at. Here's VFC. It would be undervalued at $53 in this, but it's selling actually for $41. So this gives you an idea, and it's paying 4.83% in dividend yield, which is very, very good. So this is Jason Fiber. He actually has a great YouTube videos, always update, and it's another way he talks about dividend investing if you want to learn more about that. And he basically looks at, like, this is an example, Air Products, and when he went through, he compared it with different discount models and saying that the final valuation is 330, and I think the stock was selling for approximately 280. So dividend investing, this is an example, a true example of someone that I know that started, the person had no debt, was debt free. We talked about that. He had saved up $200,000. He was getting $6,000 a year, which isn't that much to live on, but over time it will build up. And so basically he started in 2008. Remember, that's before the market tanked. And you can see that how the market has tanked down to March 2009. During that time frame, his portfolio dropped from 200 to 100,000 was cut. But his dividends, instead of 6,000, went up to $8,000 in dividends. And with great companies, even though their price dropped in half, they increased dividends even higher. So, and the reason his dividends kept going up, he did not sell any stock. You do not sell great companies. And the only time you sell a company if they've cut dividends. And these companies have been paying dividends for over 50 years, increased dividends. So he did not sell, and actually bought more when it was down at the bottom. Here's an example of McDonald's during that time frame. Even though their stock dropped almost in half during 2008, 2009, they increased their dividends from $155 to $2. The next year, they increased it to another $2.26 in 2019 or 2010. So the point is, great companies increase. That's why his dividends went up. Now, he actually been spending all his dividends since that time. So over those 14 years, now remember, he started with 200,000, it dropped to 100,000. His number actually has grown to over $1 million, and that's spending all his dividend, because these companies actually grow in value and price, but also the dividend growth is the secret, adding more and more money coming in all the time. And now he gets $34,000 a year in dividends. That basically in his tax bracket is 15% is what he gets. He has to pay on those. If you make less, you and your spouse make less than $70,000 a year, or I think it might be 80, basically you will pay no taxes on this. And the average dividend yield, remember he was getting like 2.5%, 3% starting, had grown to 11%. Another thing about the portfolio, during that time frame, he averaged 19.41% because these are great companies. The S&P 500 without dividends, because he was using his dividends, was getting like 15%. And that's supposed to be the best, but in reality, great dividend companies will give you somewhere between 2 to 4% more if you understand how to buy them undervalued. So dividend investing, you have to understand the power of dividend growth. Remember, if, for example, you want to look at companies that actually increase their dividends, have maybe 10% a year, or basically, if they increase their dividends 10% a year, you will double what you have in your portfolio. If they increase their dividends 12% a year, your portfolio will double in 6 years. And some companies have averaged over 15% a year, which means 4.8 years, you will double. And there are some companies that are on the list that have increased their dividends every year on an average of 20%, resulting that every 3.6 years, your dividends will grow, will double. So for example, if you're getting a 3% dividend and the company grows their dividends by 20%, in 3.5 years, you'll be getting 6% return on your money. If that's true, another 3.5 years, you will be getting not 6%, but 12% return on your money. And it just keeps going up and up. Where else would you get a 12% return on money with great companies? That's the power of dividends. And basically, you look at the taxes. If you make less than $83,000, $350 as a married couple, and you're in the 10 or 15% tax, you pay no taxes, tax-free. If you make up to less than $517,000 as a married couple, you will only pay 15% tax. And then anything above that is 20% tax, but there is also a Medicare tax if you make over $250,000. So that's the tax. All this stuff is in the book. You can read about it. The bottom line for high earners, including Warren Buffett, his tax is only 23.8% on his dividends, the most he'll ever pay. Now it's tax-free in a Roth IRA. So anytime we can create Roth IRAs, or even in a business, you can put your money in a Roth IRA account. In the military, it's available also. So here's a friend of mine who developed, put everything in a Roth IRA on his grandchild or his child. In 1987, he put $2,000 in. 2002, $3,000. That's all you could put in per year. Then $4,000, and eventually now it's up to $6,000 a year. But during up to 2017, he contributed $1 million or $100,000 basically into that Roth IRA. The value now is over $428,000 in dividend stocks, and continually growing. So this is about the IQT newsletter. It's run by Kelly Wright. It's been around for 55 years. This is which you can go online and purchase that. You can get a free copy to just check it out. This was the inventor, Geraldine Weiss, who created this deal, and then Kelly Wright took it over, and he wrote the book Dividends Still Don't Lie, which is a good book if you're really going to get into this investment. And basically, letter's been around since 1966, still very popular. And my friend that taught me this has been doing this for many years. That's the person actually I talked with that increased his growth from basically 200,000 went down to 100. Now it's $1 million in his portfolio. They look at different criterias. has like 6 criteria here that they have to meet. It basically cleans up all the junk in your investments. These are all great companies that meet certain criteria, as you can see. And then you look at the undervalued section. In this case, basically you can see there's only so many stocks that are in the undervalued section of the 280 stocks that they look at. That's all you look at. This is the undervalued section of the newsletter. You look at that. We talked about that. We see that, if I buy IBM, it's $199 is the base price. Anything lower, it's really considered undervalued. And it's at 151, then maybe I would buy that at 151 or even put a limit order below that. These are other companies like Cardinal Health. That's at $76. But basically it's at $58 is what it's going for now. So yes, that might be a good buy. So that's just one thing. We talk a little bit more about all this. Here's an example of Texas Instruments. That's basically, this is Safe Simply Dividends, another website that actually is you have to pay for, but it has a lot of great insight and advice. It tells you what the dividend yield is, what the price is that day, the beta. It has grown currently 13%. Their dividend growth is a safety rating of 90, which is very safe. And you can look at your accounts and look at how much the growth has been in this. It's increased dividends for 18 years, have paid dividends for 33 years. The annual dividend rate is this. The ex-dividend date, all these things are described in the book. Look at timeliness. It says it's undervalued. And this is ways of looking, like return on investment capital needs to be above this line, significantly above this line. It tells about the company, what it is, because you need to learn about these companies, what they do, what's their moat of protection. So how do you start investing in dividend growth companies now? First, read the book. Read my book. I read, The Dividend Growth Machine by Nathan Winkelpleck. I'd open up with Charles Schwab. I think Charles Schwab is the best broker out there. There are no charges or fees for buying or selling stocks. They have great advisors and representatives. They're all paid on salary. They're not basically paid on commission. See how your previous investor advisor has done. Remember, you want to check and see, go to DrAce, download that little link we talked about before, see if what's in there. I wouldn't keep mutual funds because there's always higher fees with mutual funds. I focus on dividend stocks. Use the money to create a dividend portfolio. Do your own research, though, because you're the one that makes the decisions here. Use Charles Schwab representative. They're easy to get 24 hours on the phone, or you can go to their local office and have them help you through this process. Start slowly initially, create a, kind of look at the list, pick ones that may be highlighted or marked in bold, that they're undervalued, and then, kind of start slowly. Get a feel for this. Check the Appendix B, which is a guide to, selecting the best dividend growth to give you some more information. You just need to learn. That's all. It's not that hard. I think my 12-year-old has figured this out pretty quickly. Of course, they're younger. So I would do, but more importantly, good luck and just have some fun with it. You don't have to put a lot of money in or put everything in. Do it slowly, figure it out while you're paying off debt. Once you're debt free, you have 2/3 of your money to invest in. You can all be multi-millionaires. Just again, investment disclaimer, this is for informational purposes, and I found helpful. I'm not engaged in rendering professional service. If you require professional assistance or advice, seek a competent professional. I specifically disclaim any responsibility for any loss, liability, or risk personal or otherwise, which has occurred as a consequence directly or indirectly of using this application or the contents of this presentation. Next, we're going to move on to part 5, which is basically finding peace, health, and happiness in your life, which is probably more important than anything we've talked about so far.